The week ahead promises to be a busy one with a raft of economic data and decisions from central banks like the Bank of Canada and the ECB. Let's take a look at the week ahead for the week starting Monday, the 2nd of June. So first and foremost, let's look at the data for the week ahead in terms of the big ticket items. You can see here that we kick off on Monday with the ISM manufacturing PMI. Now, this is going to be an interesting one. It always is when it comes to the ISM numbers, but they have an ability to drill down into the data a lot better. We see separate readouts for the likes of employment, the likes of prices, and of course, with those question marks around the manufacturing sector under Donald Trump. What's the direction of travel? Well, the forecast is that we're going to see improvement up to 49.6. And certainly at the moment, there's a feeling that strong economic data allays or pushes back central bank action further, whereas weak economic data could bring it further to the fore and potentially also weaken the US dollar. Then we're looking at Tuesday. We've got the RBA meeting minutes. We've got the Caixin manufacturing PMI from China. We've got the inflation rate from the Eurozone and JOLTS job openings. That kicks off a focus on the UK jobs, where we also see the likes of the ADP payroll released. And then Friday, we see the jobs report. Wednesday, we've got the GDP figure out of Australia, the Bank of Canada interest rate decision, ISM services PMI figure from the US, the ECB on Thursday with their interest rate decision with an expectation of a cut. Canadian balance of trade, the ECB presser, the IV PMI from Canada. So a big focus on the Eurozone and Canada on Thursday and Friday. Like I said, it's jobs report out of the US and the jobs report out of Canada as well. And so let's kick off with the US. You can see here that we've got the ISM PMI figure on Monday. Like I said, that's going to be an important one alongside the services ISM number on Wednesday. You can see expectation that both of them will improve. The job openings figure expected to continue its downward trend. That kicks off a phase where we see the jobs opening on Tuesday. We see the ADP employment change. So essentially the ADP payrolls figure on Wednesday with an expectation that we remain low. Look at that 70K from 62K. And then we see the headline numbers on Friday. We've also, of course, got that Thursday jobless claims number. So Tuesday, Wednesday, Thursday, Friday, jobs data coming out of the US. Let's look at what we're expecting in terms of the non-farm payrolls. You can see 130K. That's down from 177. Now, I'll show you in a sec, but we saw this disparity last time around between ADP, which essentially really heightened concerns around a recession, and then the headline number, which came in at 177, we didn't necessarily see big deterioration. Our unemployment rate has remained essentially steady. Average hourly earnings, at 0.2, is coming back down in line with sort of pre-pandemic levels. And so at the moment, we aren't necessarily seeing anything major to worry about when it comes to the headline jobs report. The ADP number certainly did prove worrying. And you can see here this disparity of 115K between the ADP figure and the headline non-farm payrolls figure last time around. So you can see that is actually likely to continue if we see the expectations this time around. So 70K, so pretty similar to the 62K last time for the ADP. And then the forecast non-farm payrolls, okay, 130K down from 177. So a narrowing of the two, but still relatively lofty, elevated figure for the headline number, but the ADP number still very low. Markets really just care about the ADP number as a gauge of where the headline number is going to go. So if we do see weakness, considering the expectation this time around that we'll see a relatively strong or we'll see the headline number hold up, I don't necessarily think markets are going to be paying all too much attention to that ADP number in particular. But really, it's all about the direction of travel for the US economy. Are we seeing signs of a potential recession? What would be the implications in terms of monetary policy, in terms of the direction of travel for the US economy and alike? So here is the Citibank Economic Surprise Index. And I've overlaid it with the expectations of where rates will be, at what level the rates will be from under the Federal Reserve by year end. And what you can see here is that we do have this positive correlation. And what it means is the stronger the economic data, the higher the interest rates are going to be. So the less cuts we're going to see from the Federal Reserve. It stands to reason. So the Federal Reserve have a lot of uncertainty. We just saw it recently with the FOMC minutes, where essentially they said, look, given the uncertainty around policy under Donald Trump, we don't know if rates are going to have to be cut dramatically if we saw the economy really tank. But we also don't know whether we're going to have to hold off because inflation is going to rear its head because of tariffs. Now, recently, we have been hearing about the possibility that tariffs are going to be paused because of a ruling that we saw from the International Trade Court in New York. And essentially, they're saying, well, actually, Donald Trump has overstepped his mark. And so many of his tariffs are going to have to be paused until he essentially fights it in the court. So that could make a tangible difference. But it's, what's quite difficult here is also that a number of these different readings relate to different periods of time in terms of you might be looking back to a period of a month where for part of it, you were looking at reciprocal tariffs that were really high. Then you had a period where it was just China. Then you see the Chinese number coming down heavily. So a lot of chopping and changing at the moment. It's difficult for businesses. But what we can see here clearly is if we see strong economic data, so strong payrolls, strong ADP, strong, JOLTS job openings, those kind of things, then you would expect to see an expectation that rates remain relatively elevated. Now, if we look at that and relate that to the likes of the US dollar, the likes of gold, then what's the relationship? So I have inverted gold here. So essentially, the weakness of this chart for the other two would point towards upside for gold, which stands to reason, right? Essentially, if we see additional rate cuts being priced in for the Federal Reserve this year, then it's likely to bolster support for gold. So what's happened recently? Well, in actual fact, we've seen a pullback or a rise in terms of the expectations for where rates will be by year end. That's not necessarily great for gold. So we've seen gold sort of pausing. I think there's an expectation that gold will run higher. So when we see the sort of the doves coming into play more so, then we see gold really running. And then when we see the hawks starting to take a hold, gold sort of moves a little bit sideways. It doesn't really pull back in a meaningful manner because there's a lot of support for gold as things stand. So let's just jump into the chart for gold. So here is the chart for gold. And as we can see, so I like to start from a long-term perspective. And here it is. It looks pretty convincing, doesn't it? And so the question mark here is, where do we go from here? Let's go into the weekly time frame. So like I said, we've got now this view that things are starting to change in terms of the perception of where rates are going to be by year end. So we're seeing an easing in terms of that expectation for rate cuts this year. And that brings us into this sort of consolidation or retracement stage. Now, we have seen a decent pullback. You can see from the high down to the recent low, you're talking about a 10% pullback. But a lot of that has already been regained. So half of that's regained. We're now sort of 5% down from that previous high. So where do we go from here? In my mind, I think this is a sort of holding pattern before we see another push higher. Certainly the trend is very bullish. We've seen a pullback into this sort of deep retracement zone between the 61.8 and the 76.4 Fibonacci level. So we've pulled back, but there's still a chance that what we're seeing here is A, B, C, and then push higher. There's also a chance that we see A, B, C, and then D, E, and we essentially in a sort of not a flag formation, but a descending channel formation. So certainly greater confidence for the bulls comes with a break up through this recent swing high, which would be 34.38. And so we question, is this a retracement before we turn over once again or not? So this is the Fibonacci, and you can see absolutely perfectly on the 76.4 Fib thus far. So respected it well. That would point towards the possibility that maybe we do roll over, but we're turning higher once again. And so if we take out that near-term resistance level, it starts to build on the story that actually this retracement phase is done and that the bulls are going to move in to prominence once again. Like I said, when we're relating it back to the data, weak data should benefit gold. Strong data, by and large, could just provide maybe some near-term downside, but it could also just provide sort of more consolidation, essentially. So keep an eye out for this. If we break through the 3363, it gives me greater confidence that we break the 3438. And if we break that level, then we're looking like we're going to set ourselves onto the next leg higher within this very long-standing bullish market here for gold. Next up, let's take a look at the Eurozone. I don't necessarily have a huge amount of forecasts here. I'm recording this late on Thursday, so things might change as we go forward, or they definitely will change. So look out for this data on your own economic calendar. I like to use Trading Economics. So you'll see exactly what the predictions will be in terms of inflation. Now, what's notable here is that we've got inflation due out on Tuesday. Then we've got the rate decision on Thursday. Expectation is that we will see a rate cut on Thursday. And that comes down to the fact that inflation here is 2.2. Expectation that we're going to see a move down to 2.1. So inflation under control. However, we have actually seen quite significant uptick recently in terms of inflation on the core front. You can see here on the month-on-month metrics, this is core inflation. You can see in the middle section, the last two readings, 1%, and prior to that, 0.6. So you've got a lot of sort of readings in the past, over the past 12 months, that have been like 0.4s, minus 0.2, 0.3, 0.1, 0.2. So everything was hunky-dory in the first half of the past year. But the last 6 months, things have started to change a little bit, and we've started to see inflation coming back into play for the core metrics. And you can see that with the 3-month annualized figure at the bottom, up to 10.6. So the last 3 months, which is not going to be the norm, but the last 3 months, if replicated going forward, points us rising up to 10% inflation. That's not going to happen, but certainly that does point towards a reflation coming into play in the underlying metrics within the Eurozone. Is that enough to hold back the ECB at the moment? No, doesn't look like it. And you can see here the expectation for where we go from here. 2% by and large priced in. So a rate cut is essentially telegraphed here, right? So near enough 100% chance that we see a rate cut of 25 basis points. From there on in, where's the next rate cut going to come? September, that takes us down to 1.75. Beyond that, do we see another rate cut? Perhaps not. Perhaps not. That might be the end of it. So we might only see 2 additional rate cuts from here. It really comes in terms of where they sort of point towards being the terminal rate or the neutral rate, or essentially where they're going to flatline, right? Where they think it's the right amount of easing for the Eurozone. So keep an eye out for that. That's going to be key within commentary. You know, where do we stop this process? And it looks like we're pretty close to that mark. One of the major benefactors has been indices in the region. So let's just jump onto the likes of, well, let's get rid of that, and we'll bring in the DAX. So the DAX has been a big outperformer. Let's do, say, Germany 30 divided by, let's say, S&P 500, right? So let's see US markets in comparison to the likes of the German market. So more recently, what we've seen here is this is the German markets divided by the SPX, right? So long term, we should be seeing, that's not a great example. So let's go Germany. See that one divided by US 500, essentially. Here we go. So we've got a longer time frame here. So the long-term trend here is underperformance for German markets. But what we've seen recently is a historical bull run here for German stocks in comparison to the US. Part of that comes down to the US sort of not performing that well. But ultimately, this is a recalibration in terms of people's assets. A lot of people now moving funds into Germany, where we're seeing, of course, it's been beat up, but now they're going to increase spending. The Eurozone as a whole is going to increase spending. Defense spending is going to go up. So manufacturing sectors should be doing well, which, of course, the German have a very strong manufacturing sector. So it's been on a massive bull run recently relative to the US. Whether that's going to continue remains to be seen, but certainly this is the DAX. Very impressive trend. The daily time frame highlights that we have broken up through that prior high, and so we're sort of totting into fresh highs each time around. Well, we've pulled back over the near term, so there's a question mark here as to, you know, is this the top? Everyone always worries that this is the end of it, right? But ultimately, it's probably unlikely to be so. But there are some warning signs. So what you would say here is we've sort of flatlined here, so we rallied, then pulled back into that prior low. Now we've rallied into a fresh high, and now we're pulling back a little bit. So in my mind, I just see this as another retracement within a very clear-cut bullish trend. And certainly if we see a nice dovish rate cut from the ECB, then it should further play out on that narrative. Now, keep an eye out for the Eurozone inflation, because if we see another very strong inflation metric, then that could point towards the ECB pretty much calling an end to this pretty soon in terms of its easing process. But nonetheless, we've got this pullback coming into play. In terms of the deep fib levels, you're looking at 23694, which is 61.8, 23531, which is 76.4 fib. So if we continue to pull back, this looks like a really attractive zone for that trend to come back into play, given the sort of risk to reward parameters. Because if we break the 23268, then essentially to me, that points towards this potentially having topped out. But we need to see that level broken. And until then, this pullback to me looks like another potential area for the bulls to step in once again for the DAX. So finally, let's just jump onto Canada. Now, of course, Canada's been having a bit of a topsy-turvy time of late. Some people saying that apparently they're going to become the 51st state. Well, that doesn't seem likely, but, the breakdown in relations between the US and Canada doesn't necessarily stand in as bad a position. Certainly some of those sector-specific tariffs still hurting the Canadians. And so the question mark here is, will we see the Bank of Canada step in to help things? Well, probably not by the looks of it. The Bank of Canada interest rate decision is on Wednesday. Markets expecting them to keep rates steady. Part of that comes down to inflation, which is rearing its head once again. PMI numbers you can see here, expectation that we see improvement, but still very low. So weakness within the Canadian economy right now. 43 expected on both composite and services PMI metrics. The IV PMI expected to grow, but once again in contraction. That's 48.2. Unemployment up to 7% expected. So very high unemployment. Remember, over in the US, you're looking at something like 4.2, I think, inflation. Unemployment. Yep. So 4.2 unemployment in the US, whereas over in Canada, you're looking at 7% unemployment. Unemployment change, a weaker unemployment change figure. So not necessarily great, but you can see here that ultimately what we're looking at here is a resurgence in terms of inflation pressure. So when you look at the 12-month metrics, they're under control by and large. You're looking around the 2-3 kind of region for headline and core. And then you look at the 3-month annualized metrics, and we've seen it surging over the past few months, akin to the move that we've been seeing in terms of the Eurozone. Whether that comes under control remains to be seen, but certainly it is a worry. And so when we look out for this Bank of Canada interest rate decision, you want to see how they're sort of perceiving this recent rise in terms of inflation, most notably within the sort of food sector and food costs. So this is the outlook for the Bank of Canada interest rates over the course of this year. You can see markets expect 24% chance of a cut. So by and large, pricing in a pause for this meeting. Beyond that, July, we expect to see a rate cut. And then where's it going to end? So you can see a 50% chance we see another rate cut by year end. So you could see 2 rate cuts by year end, potentially not. The data that we see on Friday in terms of the jobs report could inform us further on that front. In particular, if they're worrying about inflation, keep an eye out for the wages and of course some of those PMI numbers as to how much the Bank of Canada needs to step in. But it's going to be an interesting one. Now, in terms of the market to watch out for, I haven't touched on the US dollar. So I thought dollar CAD's an interesting one. Now, what we've been seeing here really is this rise of the US dollar against the Canadian dollar. But then we've seen this almighty pullback with the greenback really coming under pressure ever since Donald Trump's come into power. So the Canadian dollar's actually done well, despite the fact that, of course, oil prices have been under pressure. The economy's been under pressure. But really, we've been seeing the weakness of the US dollar driving dollar CAD towards the downside. But we're now back into trendline support alongside the 76.4 Fibonacci level. So will we break out from this recent downtrend or not? I would say play the near-term trend for the time being, unless we see otherwise. So if we see a breakup through the 1.4 level, essentially, then it looks like we've potentially bottomed out at this key confluence of trendline and Fibonacci support. Until that happens, I would be wary of looking for longs, because there's a good chance that the weakness we've been seeing in the US dollar would play out once again. It's starting to roll over here, potential bearish engulfing pattern coming into fruition. And so unless we break the 1.4 level, for me, there's still a risk that we see this market roll over once again. And certainly if we take out trendline support and the 76.4, then it gives you increased confidence that this sell-off is going to continue to the point where we could even see us breaking out of this long-term multi-year uptrend for the US dollar against the Canadian dollar. So a really interesting point in time to be following this currency pair at the moment. I hope this has been useful. Make sure to like, subscribe, and follow for more content like this. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Thanks a lot for watching. Have a good day and have a good week ahead.